Hello traders, it's Victor from TRADEPRO Academy, and in today's video we are going to be talking about bear markets, right? We have been in a bear for a while now. By the time you're watching this video, who knows, we might have climbed out. But the point is, if you're watching this video, we're probably not out yet. Now, we're going to be talking about the survival of a bear market. Now, bear markets, they do bring out the worst in a lot of traders, investors, and just general public, right? Economic downturns do affect everyone, right? And we see a lot of that turmoil. Bear markets specifically, if you are active in stock markets, in whatever markets, bear markets do typically push people to make a lot of irrational and fear-based mistakes, whether it's panic selling, over trading, adding in too soon, crystallizing too many losses too fast, or whatever the case may be, right? There's a plethora of human emotions that are factored into this, and a lot of fear that gets drawn out in a bear. Are my positions going to recover? Maybe I've added into too many different positions. Maybe I've added a lot too soon. Whatever the case may be, we always have the underlying fear in a bear, no matter what kind of position you're in. Now, the point of this video is I'm going to be talking about different ways and different approaches that we can take to kind of subdue those fears, subdue those issues, and look at it from a different perspective and look to survive this bear together. Whether you're an investor or a trader, I suggest sticking around and watching this video. So I hope you guys have enjoyed the intro so far, even though we haven't talked about too much, but I want you guys to smash that like button. Drop a comment down below. How many bear markets have you seen? And which ones? How did it go? Let me know and smash that subscribe button before we jump into this intro. So first and foremost, what is a bear market, right? A bear market is typically classified as a market, right, in which the general indices, or if you're looking at ETFs, have dropped from their highs or current highs more than 20%, right? 20% off a peak. So that would classify technically the bear market. So the S&P 500, the NASDAQ, for example, if they're over 20% off their highs, typically, we see that as a quote-unquote bear market. Now, this is a very easy classification. Currently, we are in bears in both of them. But bear markets, right, they're more than that. They're economic shifts in balance. They're economic turmoil. They're labor market downturns. They're overall company and growth downturns. They're periods of high inflation, federal tightening, right? Whatever monetary policy systems there are. And there's more to it than just that, right? There's financial crises, tech crises, supply chain issues that encompass this bear on the underlying, rather than just taking a look at a chart and being like, well, we're down 20%, we're in a bear, let's see what happens, right? Markets, they typically drop in correction territory 10% at a time. But when we get into a bear and there's really something powerful behind it, which is a lot of the time, these bears do last for a very long period of time. In 2000, 2002, when we had the dot-com bubble, right, we had a 50% drop, I think it was a 54% drop from the highs. Currently, we're sitting at just over 20% drop in the highs. When we had the financial crisis, 2007 to 2009, we had, again, over a 50% drop. And these typical bear markets, they're not like we saw in 2020, where it lasted about a few weeks, then we rebounded with a V-shaped recovery due to some external factors, but they last over a year, right? Over 400 days is the typical bear. So this can be dragged on for a very, very long time. Now, obviously, it depends when you define the start of a bear, but realistically, we're probably in a bear in around December based on the downshifts and the turns of the market internals. So classifying a bear from the start of the year even, right, we're about 180, 190 days deep into this bear already if we're just counting into 2022. So the possibilities of this bear being over, not necessarily just yet. Before we dive into what we could do to help us survive this bear, I want to talk to you guys what I think about this bear, what my perspective is, and where we could actually start to see prices kind of come to be. So typically, when we see aggressive downturns, when we see bear markets, we have an exhaustion of fear. We have an exhaustion of market internals. We have an exhaustion of macro events. We have some kind of exhaustion that'll propel us there, which is exactly why I don't think that this bear has come to fruition yet. We haven't seen that exhaustive event, whatever the case may be. A massive recession announced. huge rate increases, the Federal Reserve not being able to do X, Y, Z, soft landing, this and that. We need some kind of event. We need something that really sparks fear in that panic sell. Because so far in 2022, we've seen a very constructive, defined, slow sell. It's been a systematic sell by institutional money. You can tell that because the VIX volatility, which does gauge fear in this market, the emotionality of this market, has not seen that panic sell spike. We haven't seen 80, we haven't seen 70, we haven't seen 90 VIX. Instead, we're seeing 30, which is fairly high, right? We're consistently seeing 30, so we've seen this very, very constructed selling continue without that massive fear sell where retailers, institutions, everyone just blindly sells to just get out of a position. We need something that catalyzes like that. Now, this last bit, remember what had happened in 2020 throughout COVID? We had to have a massive, massive influx of monetary policy supply, right? We increased the supply of money. We changed the monetary policy to super QE, right? We doubled the balance sheet, right? Now flirting around $9 trillion on the Federal Reserve balance sheet, right? These are treasuries that have been bought by the Federal Reserve to add onto the balance sheet that now are getting sold off. So when the balance sheet sells off, that's what we call quantitative tightening, right? They're tightening they're restricting pretty much, they're tightening the flow of money, the supply of money at this point. So they're going back to the banks that they were buying from, right? And telling them, hey, you know what? We have to cut the circulation of this down by a bit. So that in itself caused a lot of this rally, right? We rallied over I think it was 130% from the COVID lows in just about 2 years of time. Right, that's a massive, massive rally. I think it was close to 110% from those lows in such a short period of time. Right, these are artificially inflated assets. A lot of the PE ratios, a lot of the price to earnings ratios, a lot of the fundamental aspects of these stocks has been artificially inflated because of this cheap borrowing of money. Right, interest rates were at zero. Now we have the expectation of a 100 basis point hike, something that I have never seen. The last time we saw a 75 basis point hike, I wasn't even born yet. So we're doing this crazy rate hiking cycle plus quantitative tightening to do one thing, and that is combat inflation. Right? Inflation, the same thing that came from all this money supply, that came from that cataclysmic event, right? There was technically maybe no choice, because global economies were shutting down, a lot of things were shutting down, so we had to have that money getting flown in. Now what that caused was artificially inflated price, not only in asset classes, right, not only cheap borrowing, but in terms of goods all around. These inflation numbers spiked. CPI 9.1% year over year in 2022 for the month of June, right? These are drastic changes where the labor market and wages cannot keep up. So we have all of these different economic factors that are circling just because we had this huge influx of money at a very short period of time after that pretty much flash crash COVID drop. So we have all these artificially inflated assets, massive inflation, quantitative tightening, and interest rate hikes, and the Federal Reserve has to somehow engineer a soft landing in this market not to trigger recession, which is nearly impossible. We've already had one negative quarter, second negative quarter is on its way, and realistically, we haven't seen that cataclysmic massive sell that tells us, you know what, we're exhausted on the sell side, and no one is buying this market. Meaning this bear is not over yet. If we see 3,000, 3,200 on this SPX, that is a local bottom that I'm going to look to entertain. So in the meantime, while we wait another 190 days, if we wait another half a year, what are we going to be looking at, right? How do we survive another 200 days, let's say? Another 180, right? If we want to make it an exact year, whatever the case may be. Another 200 days of the bear. How can we survive that? The main premise is not to lose our shirts throughout this bear, right? We want to have cash for this quote-unquote generational dip buy that I've been seeing everywhere. We don't want to be adding too soon into this drop because we're only down 20% on the S&P, right? If we cut that another 20%, a lot of asset classes are going to be a lot cheaper, should that be the scenario. So let's split this up. Let's talk about surviving the bear as an investor. Let's talk about surviving the bear as a trader, because they can be different things, right? One is more active, the other one is more passive. But again, there are a lot of principles that you can take from either or and align them to your trading style. So as an investor, you have a much wider time frame, right? You have a long-term goal. Even if your goal is coming in the next few years, it's still years and years ahead. Now, if it's coming sooner than that, then we have something else to talk about. But we have a very long-term perspective and goal in the market, meaning that when we have these knee-jerk reactions, these sells, these larger hits to the downside, we have to keep in mind that it's not always the right thing to panic sell your positions and actually realize a loss, cutting down your capital in your portfolio, than it is on potentially holding out until we see that rebound, whatever the case may be. If you have a long-term perspective and your analysis says that in 10 years, XYZ should be worth XYZ, there isn't too much of a reason for you not to hold this position and actually panic sell it, right? Avoiding those knee-jerk reactions can actually keep your average cost down. It could keep you in the market. It could keep your capital safer, right? Rather than continuously over trading in a portfolio or an investment account to find better prices. Number two, a lot happens. Fear happens, markets drop. You have to revisit what your goals are as an investor, and you have to revisit your risk tolerance. Because if your goals are coming up very soon, maybe you have to be much more risk averse, and you have to sell some things off or rebalance or refit your portfolio. If, right, your goals are in 10, 20, 30 years, then you have a lot less to worry about. Typically, markets do rebound fairly nicely in those extended periods of time, especially for investors with very sound holdings. So understand what your risk tolerance is based on your goals as an investor, and you can make different decisions based on that, right? Because for me, for example, if I have a 20, 30-year time horizon, I'm not going to be quick on the trigger to start selling things off right now, even if they're down 15, 20%, right? If it's a company that I believe will be up 200% in the next 5 years, then right now, this downturn, I'll probably be looking to add in at a certain point. And that brings in the next part, investing more consistently, right? Now, it doesn't mean every single minute dip you buy. Take a look at what you think from a fundamental, from a technical perspective, are key areas on a specific stock that you like to own, right? Maybe you want this thing trading 15 times its earnings, or whatever the case may be, or at this certain volume profile, at this certain level. No matter what that case is, you should actively add throughout this, right? Because it's going to be impossible, number one, to time the bottom. If you miss the rebound, you're going to be even saltier. So you could have maybe a little worse average cost base, but still add consistently throughout, right? If you're expecting, you have to do a macro analysis on this as well. If you're expecting a 40% downturn from the tops, then adding all of your capital in the first 5% drop, 10% drop isn't necessarily the best thing to do from that perspective. But investing consistently throughout and it's still having cash, remember you're doing this mindfully, having cash for when we actually do get a strength and reversal is a really good way to go about things. Split up the cash. Let's say you have 10 grand, right? You split it up into 5 different portions. Portion 1 when we drop X amount, portion 2 when we drop X amount, portion 3 when we start actually rallying, portion 4 when we start really coming out and it's confirmed that we're out of this recession, for example, right? Keep that in mind. Number 4, we can rebalance, right? We can rebalance, change asset classes, right? When we notice those different shifts, we can do our sector analysis. Maybe we want to be long highly rated bonds for a long term instead of being long just 100% equities. Maybe we want to be in certain equities like energy more so than other equities. We want to make sure that we rebalance our portfolio so we're not just heavily invested as we were in the bull, because things change and those conditions will change. And then finally, as an investor, we always have to keep in mind what the final goal is. Keep in perspective your time horizon, your goals, where you need to be in XYZ years, instead of just thinking of the current day, the current week, the current month. If I have a 20-year time horizon, I'm not going to be very focused on what happens this week, right? I'm going to be focused on where do I want to add into a position. That's where I'll add into this position, right? I need to keep a perspective on what we should be doing with those long-term goals, right? Now, we wrapped up a lot for the investors. There's a lot there to consider. It is a longer game. We have to understand that. But as a trader, you could really do well or do extremely poorly in a bear market because, again, it's a faster paced environment. It is on the intraday. It's on the smaller time frames. It could be the weekly, right? Whatever. If you're swinging, if you're day trading, the point is you're in a volatile market space and you could really make a lot of mistakes. So let's go ahead and talk about surviving a bear as a trader. Number 1, we have to avoid a bias. Why? Bear markets have bear market rallies. They could be face rippers with buy stop runs that rally 20% off the low. If we're just short, or just trying to buy every dip is even worse, you are so biased that you're going to forget what the big picture is here, and your analysis as well is going to be lost. We have to avoid biases generally in markets, but especially in bear markets. You cannot time the bottom that well, right? You can time areas, you can time specific movements. However, trying to buy every single bottom in a bear can get you killed as a trader. Number two, we have to understand that we have to cut our losers quicker, right? Losers can turn very big in a bear, especially if you just keep buying the dip. We don't want to overstay our welcome because bears are typically more volatile, especially when we have those panic sells. Number three, potentially tone down your trade size. You don't need to trade massively if you're uncomfortable in a situation. When you build that confidence in a bear, yeah, you can go back to trading normal size and even bigger maybe. Number four, you got to be more selective in your trades. Not every trade is going to be a good trade, especially if you're swing trading. Swing trading requires a lot more specificity in a bear, where we're going to stall out, where we could potentially bottom out. You have to be very, very selective in how you're trading this bear and really tone down your qualifiers and stick to things that you have seen and proven to yourself that work based on backtests. Another thing, we want to be very cautious swinging bullish naturally in a bear if we're swing trading and we're just looking for dips to buy. Buy relative strength if you have to do that, right? Be very, very cautious timing this because it's very difficult without a lot of tools that have been proven, like I've said. And then finally, even if you're day trading or swing trading, always keep an eye on the macro perspective and the order flow of the market. Are there inflows? Are there outflows? What are we doing from a macro perspective, economically, monetary policy, right? What is going on? Are we slowing, growing, this, that, right? Are there inflows, outflows? How is supply chain doing? How is inflation doing? We still need to know and follow those reports like CPI, PPI, all tradable events. So, a lot to take in here for both investors and traders in surviving a bear. I hope you really enjoyed this video, and remember, rewind it, rewatch it, let us know what you think down below. What do you think the market bottom is? Are we really going to be in a super deep recession? What are your thoughts? Drop a comment, hit that like button. If you guys want to chat more about this, community.tradeproacademy.com, our free Discord's right there, and don't forget to subscribe. If you want to watch our free master classes on options or futures, they're on our website, so go check those out, and we'll see you next time.